Hello everyone and welcome to the fourth part of the webinar series on using technical analysis from a trader's perspective. The series has been specially designed for the investment challenge competition organized by the CMT Association. This is your host Prasenjit Biswas, and today I will be discussing about market sentiments. Now, before I proceed to the main agenda, let's go through a quick recap of what has been covered so far in the previous few webinars. So in the previous webinars, we talked about trend lines and how you can use them to identify certain trading opportunities and also use them to identify patterns using trend lines. And I have also shared my experience on the frequency of the occurrence of the various patterns like channels, triangles, wedges, pins, and double bottoms and tops. So this is what we had already seen in the previous webinars, wherein I mentioned that these are my experiences, and I feel that it's the triangles, the flags, and the channels and the trend lines that are more or less like at a 20% frequency, and this is the these are the category of the formations that you will encounter in your day-to-day life. And of course, the rest of the 20% categories come from the reversal formations like wedges and the head and shoulders and the double bottoms or the triple bottoms and the tops. So this is what we have already covered. And then regarding the indicators, in the last webinar, we discussed about how you can use RSI and volume along with patterns to filter out trades. I had talked about using a 5-period RSI that I personally use, and we also discussed about how these overbought and oversold readings are to be interpreted. We also looked into the aspects of volume, wherein I mentioned that volume at the breakout point is the most critical thing to be watched out. And of course, the concept that volume goes with the trend is what we are already aware of. So volume kind of gives us a confidence in terms of the conviction that is there whenever there is a breakout or a breakdown. And of course, the aspects of RSI, to come again to RSI, we know that RSI is kind of a double-edged sword, wherein an overbought reading does not necessarily mean that it is negative or detrimental to the stock. In fact, where a breakout comes in, we generally see a high reading on the RSI, and it is only when the trend has achieved or reached to a certain degree of maturity, it is then when higher reading on the RSI would be would actually warrant some kind of a caution. So this is what we learned. All right, so now let's begin with today's topic on understanding market sentiment. And I'm sure that all of you here will agree to the fact that having a broader perspective of the market environment surely gives us an edge. Now, for this purpose, what generally people do is that they take a top-down approach, wherein they try to analyze some kind of a benchmark index. Like in India, we have the Nifty 50. And some people also try to keep a track of the major global indices like S&P 500, and then also look into the other asset classes to do an intermarket analysis. And then they further look into the individual sectors to get a better clarity of what's happening beneath the surface. So this is the broad idea about the top-down approach. And then in addition to this, some people also prefer to look at the derivatives data like the PCR or the open interest concentration. And then again, yes, the institutional activity, like what foreign institutions are doing, is something which a lot of people are also interested in. But then the issue here is that at times the broader market may not be in sync with the main benchmark index, and it might kind of give you a false impression of strength or weakness. So like if we compare the highs of 2018 with Nifty versus the mid cap 100, then we will see that Nifty has made a sequence of higher highs in the following next few months, and it kept on making a sequence of higher highs, wherein the mid cap index, the mid cap 100 index, which is basically the correct parameter for measuring what is happening in the stocks, kept on making lower highs, and it really did underperform in comparison to the Nifty. Now, what happens here is that Nifty being a market cap weighted index, it kind of it is really skewed in nature, and probably, to my understanding, if I have got the numbers correct, then probably 20 odd stocks add up to about 78 to about 80% almost of the market cap of index. So basically, when you are looking at index like Nifty, then you have to keep this in mind, that it's like a heavily skewed index really, and based on purely on the analysis of Nifty, I mean, it could at times not really give you the real picture of the environment that the most of the stocks are operating. So in India, practically, we have about a list of 200 stocks, which are practically liquid in nature and kind of traded on and off by most of the market participants. The point is that in terms of the underperformance, if we even like look at the whole data now, then we will see that from the highs of 2018, where Nifty was at about 11,000 odd levels. So from that point, markets have moved to about 15,000 plus levels today, and the mid cap index, which made a high of about 22,000 approximately, or 21,600 kind of levels, is just about 10% higher from those highs of 2018. So the point again that has to be kept in mind, that looking at the main index or Nifty may not be sufficient. Not to say that it is useless, but then it is not sufficient in my opinion. So unless you're trading Nifty futures directly, we need to look into much deeper depth if you really want to understand about the market dynamics. Before I discuss about my approach for understanding market dynamics, I want you to actually spend a couple of seconds on this slide and figure out what was different in both the charts. Well, if you ask me about what was different, there was no difference in terms of the pattern. Both had a symmetrical triangle breakout on the same stock. It was Ambuja Cement from a different time zone, but then the outcomes were completely different and opposite. So what was basically the factor which was different here? So if you want an answer to the question in the previous slide and really want to understand what is my way of looking at the top-down approach, then please do concentrate on this slide, right? So to me, sentiment is actually the key. So sentiment has a lot to do with the market dynamics, and it has a lot of impact on the patterns and how the patterns will behave, and how the price action will actually pan out after there is a breakout or a breakdown, and how the overall performance of the pattern will be done. So that is very important to realize, and I realized this thing over a period of time and through my own experiences. So just to make you this concept, explain this concept clearly to you, I will actually take you through a small example here, and I will actually just flip this chart. Okay, so you can already see a symmetrical triangle formation here. So basically the idea is that there are three types of players in the market. So the first player in the market is a strong player, the player who has the the highest amount of information, or the strongest hand that we call in the game. So let's call him player A. And then we have the second player B, who is like, the momentum traders, like someone like me, or possibly the future traders like you. And then we have the third category of the player, who is last in the information chain and probably the weakest player in the game. And so we'll call him the player C. So now what happens here is that if the market sentiment is strong, then the person who has initiated the trade, the player A who has initiated the trade at these levels, I mean, of course, he is going to be the one who has initiated the breakout, and he would have bought the stocks right at the bottom and probably got the best deal. So he is the one who is actually not in a hurry to dump his stocks at this point. So when there is a breakout above these levels, so the player A is not edgy about dumping off his stock, and he is going to wait patiently. Now, if again the sentiment is strong, then there are momentum players like me who are waiting for some kind of a breakout to happen in any of the stock, and they are really going to go for it. And then they will further push the stock prices higher, so from the breakout point to somewhere around these levels. And by the time the stock moves up to these levels, it would probably would be making a lot of noise in the media, and it would be all over the newspaper pages and the television channels. So that's when probably it catches the attention of the less informed people in the game, and that would be the players under the category of C. So this is where probably the player A would dump his stock, and also the momentum players who bought at these levels, who actually pushed the breakouts, they would also come in and try to dump their positions here. And so this is the point where the player C is the opposite party, and he is going to be buying the stocks from the category A and B. And then, of course, what will happen is possibly either a correction or a complete reversal of the trend. So this is how the dynamics goes when the sentiment is strong. And then if in case the sentiment is not strong, in that case what happens is that, of course, the player A would be buying at the lower level, again similar to the previous one. But then what happens here is that at this point, if the sentiment is not strong here at this point, then the player B, the momentum players, would be completely missing. So there would be few players coming in, but then majority of the players would not really be interested to take the trade, and it would be only the players from the category C who will be there in the game. And basically the player A would be edgy and would be quite happy to offload his stock, because he would be having some kind of an understanding about what is coming next, and probably he is not convinced about holding the stocks further. Now, the reason why the category from the player B would be missing is that, say, if in case the sentiment is really weak, then what happens is that if I, as a momentum player, if I have taken a trade on, say, X security, so that stock, if it has not gone up, then probably I might try to take another trade on some security, say Y. But then if both the stocks are not moving in my direction, and probably if one of them has already triggered my stop losses, then I would, of course, be slightly careful in terms of taking any further trade. So the next trade, even if there is a breakout, I would not be really going for that trade. So that's why the momentum players, if the momentum is missing in the market, if suddenly their positions, if they get stuck, then they hold back for some time, and that is the most natural thing to do, and the logical thing probably to do as well. So that is the whole thing. So in case the sentiment is positive, then of course the trades would be rotated. So if I would be taking a trade on, say, some Reliance, and if it goes up, I'm happy to let it go, and then I would be looking to take a trade on maybe some ONGC, and even if that goes up, then I would be taking a trade on BPCL. And if if now I'm done with the energy sector, then probably I will be looking for some other sector wherein I might switch my attention to banks. And if I see that there is some momentum activity happening in the banks, then the same cycle would continue. So as long as I am taking trades and I'm able to exit profitably, I am in the game and I am going to go for it. But the moment I get stuck, so like in this case, so that means there is something wrong about the market, and probably which we do not know. And that's when all these momentum players, they completely, probably they would actually look to take a contra trade as well. So they might even go and take a shot near the resistance line. So that's what it is. So the key here is that basically, to me, understanding the market sentiment is very important. If you have an understanding of the behavioral aspects of the market participants, then that's what probably will give you that edge, which is required to be a successful trader. So how exactly do you do that? So to me, the market sentiment is the key, and then what exactly you do is very simple. It's not very complicated. It's just that you try to look into the market internals. And the easiest way to do is that, the principles that I have discussed in the previous slide, you look at the whole of the liquid basket of stocks, which is the NSE 200, and you scan through all the stocks and you run through all the stocks and you try to look at each and every individual script from the lens of the trend lines and how many breakouts you're able to see and how many breakdowns you're able to see, or do you see that there is no trade that you're actually able to able to take, or there are no opportunities in the market. So that's what you have to look into. You have to look into the psychological aspects. So I mean, this principle can also be applied at a sector level also. So if you're trying to, let's say, analyze the banking index, then probably you got to look at the banking stocks in totality and look at all the banking stocks together to find out if there is any kind of biasness that you're able to detect using the concepts of trend lines or the patterns, the kind of setups that you are able to see actually on the screen. So I'll just quickly switch my screen to the charts, and I'll show you like how we can actually do it. So I'll just select the group of stocks from the NSE 200 basket, and I have just used kind of a mechanical indicator to do this. And of course, it's slightly becomes easier for me to do it every day, because I have to do this every day, and maybe I do it multiple times in a day, and therefore I have devised a mechanical way of doing it. And this indicator I have designed myself, and I call it True Breadth Index, which unfortunately is not there on any of the charting softwares, this being a proprietary model. But nevertheless, the idea is that you have to look at all the stocks from the perspective of the trend lines and the breakouts that you're able to see, or the momentum that you're able to see. So let's say I start with the first stock, and then let's say I'm just running through all the stock. Like this stock particular, this AB Capital is giving a breakout, and then let's say, so all the markings that are being shown on the screen like are giving me an indication of what is the biasness in most of the stocks, or what is it that I'm able to see. So I'm going to, like, this is a negative stock, and then let's say if I pick up this stock, this is Asian Paint. So there is a nice trend line which is running across, and currently the prices are near the support area. So this is basically the support area of 2400. So in case if there is a breakdown, it's going to be detrimental to the stock. And similarly, on the other side, there is this stock called AU Bank, which is like kind of a flag structure. As you can see it on the screen, like there is a vertical move here, and then this is the congestion area, and probably if it breaks through this higher levels of about 1150, then maybe there could be another leg up. So this is how I'm doing it, like at a very crude level. So this does not have to be an accurate one. It is just to get an overview of what is happening. So again, like in this case, this Axis Bank, like it looked like as if it is trying to give a breakout from a flag-like structure here, and it moved the the other day, and it went up to about say 800 odd levels up till this point. But then today, as we can see, the bar is quite negative in nature, and it is not a very bullish thing. So the psychological understanding angle is that there was a bullish breakout here, so a lot of people might have got in here, but then the conviction looks like is kind of shaky, and it is not like a full-fledged buy side trade. And this negative price action is kind of making the stock slightly neutral to negative in my opinion. So similarly, we just keep on running through this. I just will run across. So Bank of India is a very strong stock looking at the moment. It has a as you can see high amount of volume, and it has gone up. So this was one more stock, BBTC, which is of course not a very popular stock, but then it is looking like negative. So like this, we keep on running across the whole of NSE 200 basket, and that should give you a feeling of what is happening in the market. So like this is a stock which is Dabur, which has a very clearly defined support trend line. So now two things can happen: either the stock can bounce from these levels, or it can give a breakdown below these levels. So this is what I generally look for. So now this is Dr. Reddy's. So this stock actually gave a breakdown here, and then it went down all the way. Then it had a a series of couple of days wherein it saw a counter trend rally, and now again the stock is like in downtrend and getting into the next leg of the move to the south. So this is Eicher Motors, again a breakdown, like it's almost like a double top, if you can see on the line charts. So it's like a double top, and it is breaking down from these levels of 27, 30 levels, and it's kind of negative in my opinion. So there's a stock which is giving a breakdown. So let's say something like this, Escorts, this is also like it gave a breakout, but then it did not achieve the target which it was supposed to achieve, and now it is correcting. So again, it is like kind of a neutral stock. It is not, I would say that it is like a pure buy side high momentum stock. So and then let's say this is Fortis. So this is what looks negative to me. It is below the support trend line. And then okay, so this is a Godrej Consumer Products. So this again, as you can see, is giving kind of a short signal, and so this looks bullish. Gujarat Gas. So again, this is HDFC Life. It is hovering around a support line. This is Hero Motors. Again, it has a support line, so it can break down below this. If it breaks down below this, then being one of the leading stocks in the auto sector, can do a damage to the sentiment of the whole sector. So this stock is what I'm going to watch out for very closely. So the breakdown level would be somewhere around 3,400. So again, this is Hindalco. Like it looks bullish to me at the moment. So this is how I'm going to run across through whole of NSE 200, and probably this kind of will give you some kind of an idea. Now, if you keep on doing this every single day, or whenever, like maybe a couple of times a week, then it will actually give you a sense of what is happening in the market. You don't have to spend so much of time. If you're doing it every day, then you will already know. Let's say if you're looking at this ITC chart, or let's say some JW Energy chart, then this channel is already drawn in your chart. You don't have to redraw it every day. You already know that there is a rising channel on JSW energy, and in case if there is a breakdown below 70, it's a short. So you're already aware of it. So you don't have to spend much of time. So with practice, you will be able to run across through the whole of NSE in just a matter of maybe 10 minutes and or even lesser. So the idea here is that once you kind of get a feel of what is happening across the stocks, you will be able to kind of segregate all the stocks into broadly 4 categories. So the first would be a stock into an uptrend and with high momentum, and something like a kind of a breakout stock. So that would be your first category. And then the second category would be something which is an uptrend but not really making any noise. So it is something like which is just drifting higher, and it's not really a stock that you want to buy it right away, or which is going to be in your immediate watch list. And then on the other side, like something which is giving a breakdown or about to give a breakdown, and if there is a breakdown, then that would be like a fresh trade. So for example, the Eicher motor that I just showed you would be in this category, which is giving a fresh breakdown, right? And it's a short trade. And then of course the fourth category would be the stocks which are in downtrend but without any momentum. So broadly, if you segregate every stock, then you would come up with this kind of a matrix that you can see here. So the dark blue shaded area is the the number of stocks in percentage which is in high momentum, and then the light blue colored area are the number of stocks which are in uptrend, but then the momentum is not there. Similarly, on the short side, the dark red category is the area which is showing the stocks with high momentum on the negative side, and then this category is the stocks which are in low momentum on the negative side. So this is kind of giving you an idea about what is happening for any given single day. So this is like for the data of 16th February, and we are kind of let me just remove all this. Yeah, okay. So now if you create a series of metrics over a period of time, then you would be able to see something like this, and it is kind of giving you an idea about what is happening in the market. So this is a plot wherein I am showing you just about the data from the 1st of Jan till about the first week of Feb. So here what we can see is that the markets in the first week of Jan actually went up to a new high, and this is what I'm talking about. This is the blue line is the mid cap 100 index, and the black colored line is your Nifty. So I have plotted both the indices together for your better understanding. Now the plots below are the histograms that I just showed you in the previous slide. So the light colored area is the the percentage of stocks which are in uptrend but without any strong momentum, and the dark blue is the are the stocks which are in high momentum and in uptrend, and then like here the red colored ones are the ones which are giving a breakdown and in high momentum, and similarly the light the orange colored ones are the stocks in downtrend in low momentum. Now what is interesting here is to see that the markets have been going up here, as you can see, and the number of stocks in uptrend, whether there is a strong momentum or low momentum, it is pretty healthy here. But then what happens here is that there is a dip in the market, and with that dip in synchronization, the breadth data also comes down. But what is important to note here is that after this fall for 2 days, the markets also went up, like here. But then what happened here was that your breadth data on the positive side did not pick up. So this was a very clear indication that there is something wrong with the market. So this particular move is what I'm talking about. Here the markets went up from about 14,100 200 kind of levels to fresh high of 14,500, as you can see here on Nifty. But then the breadth data here did not pick up as much, and then obviously you can see that the market went into a correction for the next 5-6 days, and the breadth data kind of picked up negatively on the downside. Now again, when this particular let me just remove all this, and now again, as we can see, up till this particular point, the breadth data looked pretty much skewed towards the negative side. But something interesting happened here. On this particular bar here, as you can see, there was a jump on Nifty and the mid-cap index together, and also your breadth data picked up. So there was a kind of a signal that the momentum is again back in the market, and there is a sharp reduction in the number of stocks which are in downtrend. Like here in the previous day, when markets closed at a low, the number of stocks in downtrend which are in high momentum was pretty significant, and there were absolutely no stock which was in high positive momentum. But then what happened next day is important. So here the number of stocks which were in downtrend have completely vanished. So almost there is nothing which is in a strong downtrend. And as a matter of fact, you can see an uptick in the stocks which are in positive momentum. So this kind of gave an indication that okay, the sentiment is again turning around, and the general biasness in the market is again getting switched or reversed on the positive side. And like over the next few days, the markets kept on going up, and of course your breadth data also went up. So as you can see here, so this is a general idea, which probably has given you some idea about how to look at this internals. But believe me that if you practice it for a reasonable period of time, maybe about a month or so, then it will give you a lot more clarity. At the moment, it might not be looking very, very clear, but then with practice, I'm sure that you will be able to read the data in a much better way. So with this, I will just show you some practical examples, and let me flip my screen onto the charts again, and just let me show you the charts here. And let's say if I was looking at some sector, let's say if I wanted to analyze Nifty IT, then I would maybe one way is that I can directly look into the IT stocks, and I can just like try to figure out what is happening, or the alternate way is that I can look at the IT index. So in front of you, what you can see on your screen is the IT index, and as you can see that there is a nice trend line which is running across, defining the trend, and maybe you can say that below this trend line there could be a change of trend. But the other way of doing it is that you actually look into the components of the IT index. So I can actually choose the IT index stocks. So here it is. CO Forge is what I am looking at. So this is the whole idea behind using market breadth and using this to analyze the sentiment. And with this, I come to the end of today's webinar. And in the next webinar, we will actually be looking at real life trading. With this session ending here, we have covered about 4 sessions. And in the 5th webinar, we will be looking everything in totality and trying to understand what can go wrong and how exactly trading is to be approached. And once you approach the real market, what are the problems that you are going to face, and how do you keep yourself in the game, and what are the psychological things that you are going to face. because at the end of the day, learning the theory, in my opinion, is very easy. I mean, if you spend a couple of hours every day and you do it for, say, about a couple of years, then probably you will know a lot of theory and you can explain how things are happening. But then when it comes to real life trading, that's when the psychological aspects come in. So the difference between a trader from another trader would be in the psychological aspects. So the psychological bent of a person to another person. So that's where the emotional controls and everything comes in. And so that is the idea of the fifth webinar that we will be conducting, wherein we will be discussing all of these things. And we hope that you enjoyed today's session. So thank you very much.